At this moment, silver is flashing a price on trading screens around the world. In New York, that number sits near $70 an ounce. It looks calm, ordinary, familiar. But in Japan, that same ounce of silver is selling for nearly double. Not a different product, not a different grade, the exact same metal. One market says it's worth 70, another says it's worth 130. That difference is not noise. It's not a rounding error. It's a warning. Because when markets function properly, gaps like this don't survive. Banks, funds, and trading desks are supposed to erase them within minutes. Buy where it's cheap, sell where it's expensive. Profit disappears as prices converge. Except this one isn't disappearing. And when arbitrage fails, it's not because traders are asleep. It's because something deeper is broken. Welcome to Gold Silver News Channel. Before we go further, let me ask you something honestly. You've probably watched financial news for years, charts, forecasts, talking heads, but how often do you stop and ask whether the prices on the screen still mean what they're supposed to mean? If you care about that question, you'll want to stay ahead of what comes next, because when financial systems fracture, portfolios don't get advance notice. Now let's talk about what's actually happening. The price most people see, around $70, comes from futures exchanges in the United States. That number drives headlines, trading algorithms, and investment products. It's treated as the global price of silver. But in Japan, people trying to buy real, physical silver are paying almost twice that amount. Coins, bars, metal they can hold, store, and remove from the financial system entirely. An 80+% premium is not normal. In healthy commodity markets, premiums cover logistics and margins. A few percent is routine, 10% suggests stress, 20% means something is tight, 80% means the price mechanism itself has failed. Economists call this a breakdown in price discovery, the process by which markets are supposed to reveal true value through buying and selling. When price discovery works, paper markets and physical markets stay aligned. Right now, they are not. In New York, silver is mostly a contract, an agreement that can be settled with dollars. In Tokyo, silver is metal, and people are paying whatever it takes to secure it. That difference matters, and it points directly to a currency problem. Japan's yen has been losing value steadily. Years of ultra-low interest rates and aggressive central bank intervention have kept borrowing cheap but hollowed out purchasing power. Savings accounts no longer feel safe. Cash feels temporary. When people stop trusting money, they don't speculate, they migrate. They move into assets that can't be created with a keystroke: gold, silver, anything tangible. This behavior isn't new, it's ancient. What's new is how visible it's becoming. Silver premiums in Japan didn't jump overnight. They climbed gradually, 5%, then 20, then 50. Now they're approaching levels that historically only appear when systems are under extreme stress. And the most important detail is this: large financial institutions aren't closing the gap. Normally, they would. So why aren't they? Because the silver market most people see is not a physical market at all. It's a derivatives market. Futures contracts represent promises, not metal. The vast majority of those contracts never result in delivery. They are closed out in cash. Only a tiny fraction of futures buyers ever ask for actual silver. That's by design. The system works as long as most participants accept dollars instead of metal. But once too many people ask for delivery, the math stops working. Official vault reports list hundreds of millions of ounces stored, but only a small portion of that silver is actually available to satisfy delivery requests. The rest belongs to someone else or isn't designated for settlement at all. Against that limited supply sit vastly larger paper claims. This is leverage, and leverage is invisible until it's tested. Japan is testing it. Dealers there aren't buying futures contracts, they're buying bars. But sourcing large amounts of physical silver isn't as simple as clicking buy. Industrial bars must be refined into smaller units. Refineries are already running near capacity. Shipping precious metals requires security, insurance, and regulatory approval. And when institutions attempt large withdrawals, friction appears. Paperwork slows, cash settlement is encouraged, because widespread physical delivery would expose the imbalance. That's why the arbitrage doesn't happen, not because it's unprofitable, but because it's structurally constrained. The Tokyo price isn't a distortion, it's the cost of certainty. For many Japanese savers, this isn't about returns, it's about preservation. Years of disciplined saving are being eroded by a weakening currency. Doing nothing feels riskier than paying a premium. And this pattern isn't limited to Japan. Across Asia, physical demand is rising, premiums are expanding, delivery times are stretching. These markets have always favored tangible ownership over financial proxies. The result is a geographic split. Western markets remain anchored to paper benchmarks. Eastern markets are drifting toward physical reality. Two prices, one metal. History has seen this before. Attempts to hold official prices below real demand eventually fail. When they do, repricing isn't gentle. So what happens next? There are only a few paths forward. One possibility is normalization. Demand cools, supply catches up, the currency stabilizes, the gap narrows. That outcome requires trust, coordination, and time, all of which are in short supply. Another possibility is permanent division. Paper prices continue to trade one way, physical markets trade another. The benchmark price loses relevance for anyone who actually needs metal. And then there's the hard scenario. A major player demands delivery. The exchange can't fulfill it. Settlement is forced in cash. Confidence collapses. Everyone rushes for the exit at once. That's when repricing becomes violent. Silver may be the test case, but it wouldn't end there. Other metals, other commodities, other currencies. The deeper issue isn't silver, it's whether the post-crisis financial system, built on cheap money, leverage, and faith, can survive when that faith erodes. An 83% premium isn't a headline, it's a signal. And signals like this don't fade quietly. They either resolve through credibility or through disruption. The only real question is who recognizes the difference in time. Like and subscribe this channel.